Hey, and how it can benefit you. Chapter 1 of my new book, The Tax Bomb in Your Retirement Accounts and How the Roth IRA Can Help You Avoid It. That's what we're going to talk about here today on the Heritage Wealth Planning YouTube channel. So if you like the Roth IRA or anything else financial planning related, please go ahead and subscribe down below. The little tiny red button down there you can see. And then, of course, go hit the notification bell to be notified for future content, because we do over a video a day here and you don't want to miss it. You don't want to miss it. You don't know what I'm going to talk about. You don't know. Probably something financial related. So if you're interested in financial planning topics, you have come to the right place. So just make sure you subscribe. All right. So as I talked about in my last episode, we just did, and that's why I have the same t-shirt or the same shirt on. We're going over chapter by chapter of my new book, The Tax Bomb in Your Retirement Accounts and How the Roth IRA Can Help You Avoid It. And this is going to be chapter 1. And I'm just going to, I can't show you that. Well, I could show you the PDF version of it, but if I do, it makes my face go away. And I know you want to see my face because I don't know why. But anyway, maybe I got a piece of chicken in my teeth or something like that. But at the end of the day, I know for me, I like to see the guy or lady's face when they're doing a little tutorial, not just the spreadsheet or something like that. So I'm going to do it on my PDF, on the paper version. I use Google Docs. And then and it won't look as crisp as the book does. The book, they do a good job. Amazon Kindle, they do a wonderful job. And so this is fine. But all right, so the first thing we want to talk about, the chapter is titled The 50% Tax Increase on IRA Distributions. Now, I'm telling you right now, when I show you how this works, you will be like, oh, I never thought about it like that. Exactly. That's why you're here paying me the big bucks for this free YouTube channel. The single most important thing to understand, my friends, about the tax code is the difference between gross income and taxable income. All right, and this is where I start. I'm just going to read it to you. We have John and Judy. They have $100,000 in gross income. What do you think their tax bracket is? And what most people do, they go to the tax tables. They'll say, well, $100,000 of gross of income, they're in the 22% tax bracket. Wrong, as John McLaughlin said, used to do remember the John McLaughlin group back in the old days, the 80s, 90s. I don't think they did the 2000s. That is not true. This is taxable income. $100,000 in gross income is not $100,000 in taxable income. What we do is we take our trusty calculator, and if they're over the age of 65, we do $100,000 minus $26,600. That gives us taxable income of $73,000. If they're under the age of 65, they only have $24,000 at standard deductions. But either way, $100,000 minus $24,000, that puts them at $76,000 for taxable income. Either way, they're still in the 12% bracket because they have less than $77,400 in taxable income. You got to understand this. It's critical importance, and this is why I put it as my first chapter, to understand how the tax code works. AGI and TI, taxable income, and I never really use that terminology. I probably ought to, but AGI is adjusted gross income before your itemizations, before your tax deductions, or your standard deductions, excuse me. Taxable income is after all that stuff. You got to understand the difference. AGI will be found on the line 37 of your 1040, the very bottom line. And your taxable income, I think, is 44. I don't have my tax thing here. It's 44 or 46. I'll talk about it. I can't remember. But your taxable income is after you itemize or take your standard deductions. Why is that so important? Well, let's go back to John and Judy. Because like we talked about, it's based on your tax bracket. Okay, so now let's see. What happens if they add John and Judy, they take a $10,000 IRA distribution. All right. So they have now $83,400 in taxable income. Where does that put them? $83,400 puts them in the 22% tax bracket. Not a big deal, right? Oh, no, sorry, Bob. Watch this. That $10,000 distribution only accounted for 9.1% of their income because they had $100,000 before. Now they got $110,000. So they take 10 divided by 110. 9.1% is that $10,000 of their total income. But it accounts now for 17.6% of their total tax bill because their tax bill before is $8,426, but now it's $10,227. It went up by $1,800. All right, so if you lose $1,800 of taxes to a $10,000 distribution, what is your effective tax bracket on that distribution? We had $10,000, but we lost $1,800 of that to Uncle Sam. So now we don't have $10,000, we have $8,200. what is our effective tax bracket? Our effective tax bracket there for that distribution, not for the entirety of your tax bracket, but just for that distribution is 18%. All right. So again, $10,000, but I lose $1,800 of that to Uncle Sam in taxes. That means 18% is my taxes, my tax bracket on that $10,000 distribution. However, I was in the 12% bracket before. So what is the effective tax rate increase on that distribution? Well, before I only would have paid, if I stayed in the 12% tax bracket, I would have only paid $1,200 on that $10,000 distribution. But because that distribution put me into a higher tax bracket, I have to pay $1,800 in taxes or $600 more. So I was going to pay $1,200 if I stayed in the 12% tax bracket, but because that distribution put me up into the higher tax bracket, I got to pay $1,800 in taxes on that, which is $600 more than $1,200. $600 more than $1,200 is, well, we can take our trusty calculator. We do 600 divided by 1,200, and that is 50%. Thus, that is a 50% tax increase on a $10,000 distribution. And it's going to get worse too, because remember, in this case, my effective rate on that is only 18%. But as I still get more and more income, if I take 20,000 out as opposed to 10, my effective rate will get higher because I'm going to be knee deep in the 22% tax bracket. So does that make sense? Critical, important to understand that. Let's just go back and look again. No IRA distribution. They have $100,000 of gross income. Adjusted gross, no distribution. Adjusted gross income is $100,000. They take their standard deduction, so they have $73,400 in taxable income. And after the tax bracket, the marginal tax rate is that's 12%. But again, they still pay 10% on the first amount of money. All right, so essentially, they're literally going to pay $84.26 in taxes. Remember, the marginal tax rate is only the amount that you pay on the next dollar. It's still the beginning of your tax bracket. So for a married filing jointly, anything from 0 to 37,000, off the top of my head, is 10%. Anything from 37,000 to 77,000. Well, we can find out. Actually, I have it right here. So for a married filing jointly couple, anything that's 0 to 19 is 10%. Yeah, okay. And 1905 to 77 is 12%. So what that means is you're not paying 12% on every dollar. You're paying 12% only on the amount above $19,000. I know it's kind of confusing, but you got to understand it. You got to understand it. So here they're paying $84.26 on $100,000 IRA, $100,000 of income, essentially 8.46% tax bracket, effective tax rate. Okay. Here they're paying $10,227, but they have $110,000 of income because they have a $10,000 IRA. All right. So their taxes went up by $1,800. Their income only went up by $10,000. That's the 18% taxable effective rate on that $10,000 distribution. Because it put them into the 22% tax bracket, it is $600 more than what it would have been essentially a 50% tax increase. How does a Roth come to play here? Let's take a look. They have $100,000 of income. They take a $10,000 distribution from the Roth. Their adjusted gross income is still $100,000. Why? Because a Roth is, say it with me, tax-free. Yes, YouTubers, you guys are so smart. Which means after standard deduction, after their taxable income after standard deduction is still $73,400, which means their tax bracket is 84. Their taxable income, their tax due is 84.26. So now we say 84.26 divided by 110. And their effective tax rate is 7.6, significantly lower than the effective tax rate here of 84.26, all right, because they have more income and the same amount of tax. That's the benefit of a Roth. I hear you say, oh, yeah, but Josh, your numbers are sound, but they did receive, John and Judy, a deduction of the money going in to the Roth IRA, into the traditional IRA to begin with. Oh yeah. We're going to talk about that. Don't you worry. We're going to talk a lot about that. But here's what I say in my book. My experience, I've done this for many, many years, and have look at many, many 1040s, is that most people do not have the taxable income they think they do, even when they're working. They just don't. Like for me, I have a family of 6. We got mortgage interest. We do some charitable giving. All right. So basically, at the end of the day, we're not nearly as taxed as what we thought we were after all those deductions. We just aren't. And now with the new tax bracket, the new tax law, it's going to be even less itemized as well. And don't forget, if you're only itemizing your taxes, if you're only itemizing, you're not taking deductions anyway, unless it's a 401k. We talk about 401k contributions later on that's deferred. But if you're just itemizing, if you're just taking the standard deduction, you're not itemizing anyway. So all the deductions that you may or may not receive are all for naught because you're not going to get them because you're taking the standard deduction. We're going to talk about that. In fact, I find most people do not take a itemization. Most people are the standard deductions, and given the new tax law with the standard deductions much higher than they were just last year, even more and more people are doing the standard deduction, which means a contribution to an IRA doesn't give you anything. It literally gives you nothing. Contributions to a 401k, a little bit more, you can make the argument. But again, we're going to talk about that later on with other distributions that come from your IRA that affect your other tax-wise as well. So just remember, more income with a Roth, less taxation. That's all there is to it. More income from the Roth, less taxation. More income from an IRA distribution, more taxation. In this case, it's a 50% tax increase on those IRA distributions. All right. Most taxpayers, in my experience, actually retire into higher tax brackets because their RMDs put them there. I tell you, that's what I'm saying. So they don't have as much taxable income as they thought they did when they're working. They go into retirement. All of a sudden, the required distributions put them into higher tax brackets, just like we showed here with John and Judy. And they're like, whoa, what happened? And they're paying a lot more tax as a retiree than they could have been while they're working. So we'll talk more about other chapters on this, but I want to share with you this first chapter of the book, The Tax Bomb in Your Retirement Accounts, and how the Roth IRA can help you. Don't you worry. We're going to talk a lot about the Roth IRAs, a lot about the deductions you get on the front end from income tax, and we're going to talk about a lot how that's overblown when it comes to all the other taxes that come at you once you hit retirement. So don't forget to subscribe, comments down below, thumbs up, share the video for sure. Share away. Thumbs up always help. And let's see, comments, talk about comments. Oh, and then go to the blog, heritagewealthplanning.com, heritagewealthplanning.com. We'll see you next time for the next chapter. Thanks, guys.